Good morning, good afternoon, good evening, folks. How you doing today? I'm back with Bob Langworthy, who is a CPA that I trust to have conversations about real estate. How you doing, sir?
I'm doing well, Michael. Thanks. Good. It's good to be back.
Awesome, man. And again, thank you very much for being a part of the course. Our conversation around seller financing and how to use tax conversations to position seller financing as a good thing is magical. I've watched it a couple of times, so thank you for that.
Oh, absolutely.
Yeah. So what I thought we'd do here in episode number 2 is we tackle 5 definitions around taxes in real estate. Again, coming at the angle from a newbie, maybe they've heard they can hide income because of real estate. They've heard things, they don't actually own anything yet. So I thought we should go through 5 definitions real quick. You cool with that?
Sounds good.
All right. Well, we got to hit depreciation is the first one because I think it's all kind of built on that. So why don't you take a shot at defining what depreciation is, kind of the math behind it, and we'll see where we go from there.
That sounds good. So depreciation is Congress's attempt to give us a break on owning real estate by saying you can write off a portion of the value of the building over time. Mm-hmm. And for residential real estate, and that's what most of us are here, it's 27 and a half years. So you take your purchase price of the building, and if you're getting land with it, you have to back out the value of the land.
Yep.
And then it's straight line. That means it's an even division, 27.5 divided, into the value of the building over time. Mm-hmm. And that's what depreciation is. You cannot depreciate land, but you can depreciate land improvements. You can depreciate improvements to the building. You can, the renovations that you do. There are a lot of things you can depreciate. Sometimes people just want to take the write-off, and there's rules about that. But depreciation is a great benefit. If it's a commercial building, that means it's not a residence. It's 39 years, so it's a much slower depreciation schedule.
Yeah. So I just want to do some math for folks. We obviously have to make assumptions here. So let's assume they bought a property for 100 grand. Let's assume the lot or the land is worth 20. Hence the building or the structure is worth 80. When I divide 80 by 27.5, I get $2,909.09.
That's the amount of your depreciation. And why that matters is because that becomes an expense. Exactly. Depreciation.
A phantom expense, a non-cash expense.
You got it. It's a non-cash expense against your real estate income, that $2,900. So it's a benefit that Congress gives.
We just lost people. We said non-cash expense and we just blew people's minds. What is a non-cash expense?
Okay, that's because they've never had one of those before.
Exactly.
A non-cash
it's a wonderful
expense.
Thing.
Yes, it's an expense you claim against your income without ever spending that money.
Yeah,
I shouldn't say without ever spending it, but without spending it in that year.
Yeah, exactly. Let's think of an example. I don't know. Again, I like to think because I was an accountant. You're obviously an accountant. It's an income statement, right? The building produced this income, $1,000. You had these expenses: management, utilities, insurance, and then there's a line item called depreciation. You write down $2,909.09, and you didn't write a check. You didn't count pennies. You didn't put it on a credit card. It is a non-cash expense. It lowers the earnings of that building by $2,909.09 for 27 and a half years.
That's right. What you're describing is Schedule E on a 1040. That's where you've got that income and expense for that property. It's also worth noting that depreciation, that number, that 2,909, that is regardless of whether you paid all cash for this building.
Exactly.
Or whether you financed it, and then did a cash out and got all your money out.
Yep.
That depreciation is that same number. It's based on the purchase price and the 27 and a half years.
It has no bearing on the loan, the debt, nothing. It's just, it's pretty awesome. All right. So that's depreciation. Again, folks that don't know, what I did 20 years ago when I got started is I built a spreadsheet that mirrored Schedule E, right?
Yes.
It mirrored Schedule E. That's how I tracked my expenses. I had a spreadsheet that looked just like it. And then I turned that over to my accountant 20 years ago. Yeah. It's a magical thing. All right. So we're going to go from depreciation. We might as well hit, let's hit carry forward loss first. Sure. We go there next. What is that all about? What the hell is a carry forward loss? I hate that.
Yeah. Okay. That people don't like that. So
no, it's not
carried forward loss loss occurs when your adjusted gross income, your modified adjusted gross income, is over $150,000, and your real estate showed a loss for the year. Tax code says you can't claim that loss if you made over 150. If you made less than 150, you can claim up to 25,000 in losses. But you're in a situation where you make more than 150 and you have a loss, and that loss gets suspended and carried forward, and it gets carried forward and applied against either future income from that property. So the next year you make money, well, now you have a loss, you can apply against that, because the tax code says this passive income has to, and passive losses, they have to match up. You can only apply a passive loss to passive income. And the other scenario, so in addition to making money and using that loss, where you can use the loss is when you sell the property. Now you have some kind of a gain, and those carry forward losses apply against that gain and reduce that. So you don't actually lose the loss, but you don't get the immediate benefit.
Yeah, this is for a lot of the people. Again, I live in the Silicon Valley. I talk to dozens of people a month, and most of them bring up, hey, I want to have real estate. I want to have real estate lower my income. And I have to quickly introduce them to this thing called passive, carry forward loss. I'm drawing a blank. Carry forward loss, because you can't, right? If you're a W-2 earner and you're in the Silicon Valley making 200 grand a year, you're paying your mortgage, that's just it. And you want to go buy an investment house? Sorry, carry forward loss. I had it for over a decade. It's just reality.
Well, go ahead and buy that rental property to make money.
Yes, exactly.
Just don't buy it to lose money.
Exactly. So since we hit carry forward loss, we might as well hit passive loss as well. That's sometimes a vocabulary that trips people up.
Sure. So a passive loss just describes the type of income that you have. So passive income is either from a business you don't materially participate in, which is maybe a partnership where you're just an investor, but you don't actually do any work in that company. That would be passive income, and that can produce a loss. In fact, some of our brokers will put us into some energy partnership as an investment, and you'll get a little loss that goes on your Schedule E as well on page 2. The other type of passive income is real estate income. And anytime that you've got a loss on either of those two categories, it's a passive loss. And that passive loss can only be applied against other passive income.
Yeah. We got 2 more to go. This one is the one that hurts, folks. This is the one that if you're not ready for it, will smack you in the face and you will not like it. Trust me. And that is the depreciation recapture.
This is a conversation that I don't like to have.
It's not fun if you're not ready.
I'm forced to have a couple times a year with a client where they've sold a rental property outright. They haven't done a 1031 exchange.
Nope.
They've just sold it. They've owned it for a long time. And I'll just make up numbers here. Let's suppose they bought it 15 years ago for $200,000 and they sell it today for $350,000. They've got some closing costs, so it's more like, $320,000. Okay, so they think now $320,000 minus $200,000, they think they have $120,000 loss. Sorry, $120,000 gain. That's a big gain.
Yeah.
That's not insignificant. But then I have to tell them, oh, remember the depreciation that you took all those years?
Yeah.
Well, the government
Uncle Sam wanted back.
And so maybe they took $100,000 in depreciation.
Oh, yeah.
So now they're going from, in their mind, a $120,000 gain to a $220,000 gain that they owe tax on. And it's painful. The most painful situation is when there are new clients that's come to me. They've self-prepared their returns. I had one of these this year, and they had not claimed depreciation. It was only 5 or 6 years that they owned the property. But what the tax code says, it's depreciation allowed or allowable that has to be recaptured. So even though they never receive the benefit of the depreciation.
Oh, no.
Yeah. So you can amend.
I did not know that.
To 3 years. Yeah.
Okay.
So you can amend 3 years and add a little bit of depreciation to soften the blow. I hope to not have another one of those scenarios, but I had one this year. But depreciation recapture can be painful. It's just something to be prepared for. It's one reason why real estate investors like the 1031 exchange, where you can defer capital gains until the sale of the next property or the one after that.
Yeah. And folks, if you're in my course, you've got to go look at the videos we did around seller financing. We actually did some assumptions. We did real math, right? We assumed I forget what the numbers were, but whatever it is, we assumed that they owned it and they had zero in it, right? So they owned it 27 and a half years or greater, right? They depreciated the asset to zero. And we did some math. And, I think one example, they thought they were walking away with $500,000 and it was like, no, it's more like 310. And because again, taxes, if you sell outright, it can get you. And that's why we created that seller financing section, because you can really structure a deal. What's it called? The loan structure, the payments are monthly installment loan.
The installment sale. So here's this example we just gave is a perfect one.
Yeah.
So this seller sells their property. They have a $220,000 gain to deal with. They have a massive amount of taxes on this property that they're selling for $350,000. If instead they had done seller financing with the new owner and spread that out over 10 or 15 or 20 years of payments, you only pay the amount of gain that's in proportion to that revenue that you've received in that year. And so now you can spread that out. Well, now you may be in a lower bracket because instead of $220,000 gain on top of the rest of your income, you only have a $20,000 gain.
Exactly. Yeah,
totally different scenario. And that's a huge selling point when you're talking about seller financing with a seller.
Yeah, we created that bonus section around creative financing, seller financing. We have one side for somebody who has no equity, subject to all of that stuff. But you and I, as accountants and investors, we spend a lot of time educating how an average person can have an accounting discussion with a seller and just say, do you like the IRS? Do you want to write them a big check now or a little check over lots of years? So that section, those two videos we did, worth the price of the course all by itself. So I appreciate the time in that. We got one more. It's been very popular. I think it was in the Trump tax code back in the day. Was cost segregation or cost carry forward or whatever it was called. Want to talk about that?
A cost segregation study is when you have your property analyzed, usually by an engineering firm or a cost segregation company. And what they do with that is they produce a report that allows you to speed up your depreciation. And they go through the systems and they have a whole process that they go through. And what it allows you to do is take a chunk of that depreciation over 5 years and some over 7 and some over 15 years. And this is very commonly practiced with large syndications, large apartment buildings, multi-million-dollar projects where they're pitching it to investors who just want to be in for 5 years and get their money back. They'll do a cost segregation study. They'll speed up the depreciation. So now with that previous example of $100,000, let's add a zero to it. Let's say that was $1 million little apartment building. And now instead of $2,900 of depreciation, they have $29,000 of depreciation using those same numbers.
Yep, same ratio.
Now you do a cost segregation study on that, and instead of $29,000 in depreciation, you might have $60,000 in depreciation, but only for 5 years, and then it drops down, and eventually you can only depreciate the same amount. In that case, $800,000. Right. You're just front loading it, and then usually there's an exit, something like a 1031 exchange. I ended up doing a cost segregation study on a duplex that I have, in part because I wanted to, have that firsthand experience. I found a company that does them fairly cheap. I might have paid $500 to have it done. Okay. I'm not going to be holding that property beyond that 5-year time, so it greatly speeds up my depreciation. The property cash flows very nicely, and so this is helping me by giving me a lot more depreciation in these initial 5 years. So it's no longer the case that a cost segregation study is just for the $1 million and up properties.
That's good to know.
Rule of thumb for a while.
Yeah.
But there are companies that do them for cheap for smaller buildings.
That's very cool. Oh, I know we're going to get a lot of questions out this. So when this video goes up, if you can look up the company name and just slap it in the comments, I would greatly appreciate it. Yep. So again, folks, if you're in real estate, have questions, thinking about getting in the game, or you want to know who you should talk to, I recommend Bob from Maine Bean Counters. How do you want them to get a hold of you?
They can reach out to the website, mainebeancounters.com. That's Maine like the state. They can find me on LinkedIn, Bob Langworthy, and I am Bean Counter Bob on Instagram. Bean Counter Bob.
That might be the best IG name I've ever heard of.
Oh, wow. That's saying something. Wow. Great.
There you go. Well, Bob, thank you very much for your time. I appreciate it. And again, thank you for being a part of the course, man.
Oh, absolutely, Michael. I enjoy it.
Thanks.